So today what I'm going to speak about is, in the first instance, I'm going to set out an overview of some of those reforms and the sort of main parts of the new regulatory architecture that are going to come into effect from next year. So we had this tripartite model, and one of the clear commitments of parties in opposition, but when they came together, when the Liberal Democrats and Conservative parties came together in coalition, there was a clear commitment to reform what had come to be seen as a flawed system of financial regulation. And in particular, the flaws were seen to be around on the one hand, the kind of monolithic and extremely broad sweep of responsibilities of the FSA, which meant that it adopted a sort of single type of approach to prudential and conduct regulation. And at the same time, the division of responsibilities for financial stability between the three authorities that are up there. So that's essentially the problem that we're trying to fix. So essentially, the FSA is being split into two, into a prudential authority, the Prudential Regulation Authority, and a conduct body, the Financial Conduct Authority. The Bank of England's responsibilities for financial stability and crisis management will be increased and formalised primarily through the creation of a Financial Policy Committee, which will effectively sit like a sister body to the Monetary Policy Committee, with responsibility for overseeing the financial system, identifying potential sources of instability and risk, and taking action to correct them through either making recommendations to the regulators and other authorities, or in some cases through being able to direct them to take particular action. And an example of the sorts of tools that we're looking at are a countercyclical capital buffer, so that at a particular point in the economic cycle, the FPC would be able to tell the regulators, to the extent that they have the discretion to do so under the new European directives, but they'll be able to tell them to increase or decrease capital in order to take into account capital requirements, to take into account the particular position in the economic cycle. That's the FSCS for depositor protection and consumer protection, CFEB, which is known as the Money Advice Service for financial education and advice, and the Financial Ombudsman Service as an alternative dispute resolution mechanism. So the FS bill, which is bringing forward these changes, was introduced at the beginning of this year as a carryover, so it's not finished yet. It'll take a little pause right now. Once we get through Queen's Speech business over the next couple of weeks, we'll go back and conclude our Commons stages, and then we'll be into the Lords before the summer recess. And the plan is to get royal assent for this bill by the end of this year. So, what is the FCA? Well, in terms of scope, it's going to be, as I say, a conduct body. So it'll regulate the conduct of all financial institutions. It will also have conduct responsibilities in the market, so it'll regulate wholesale market conduct. The listing process currently operated by the UK Listing Authority, and it will also take the UK's representative place on the European Securities and Markets Authority. It will also have responsibility for some prudential regulation and those firms which are not within the PRA. And those are essentially, so the ones that are within the scope of the PRA are banks, and that's all deposit takers, so from the largest bank to the smallest credit union, insurers, and again, all of them, including small friendly societies, as well as the Avivas and RSAs of the world, and also the larger investment firms. The FCA this is not, and indeed the PRA, we're not just talking about taking one body, splitting it into two, and then sort of letting it carry on in exactly the same way, but just with sort of two brass plaques on two doors instead of one in Canary Wharf. So the idea is that these types of regulation are different. Conduct regulation and prudential regulation are different types of activities which require different types of organisational cultures, different types of supervisory skills, different types of management structures, and different rule books. And so in fact, one of the key drivers of this reform is that by splitting the regulator into what is often called a twin peak system, then you create an organisational structure which will allow those differences to come out. And so thinking about the FCA, these are some of the aspects in which we're trying to design a regulator that's going to take a different approach to conduct regulation. There was support for the notion of having a more flexible and responsive regime with a single regulator for all financial services, bringing consumer credit under the same umbrella. But there were significant concerns expressed about the change that this would give rise to, the change in requirements, the loss of certain consumer protections that exist under the Consumer Credit Act regime, the cost of the FCA and what that would mean for firms who are used to operating under the regulation of the OFT, and the fact that this is a very diverse market with lots of different types of services offered by a wide variety of different types of firms, large firms, very small firms, and that diversity needed to be taken into account in designing a new regime. That we're aware that while this process is going on, this does give rise to a certain degree of uncertainty about the future of regulation, and also how it's not only what's going to happen once the transfer takes place, but making sure that the regulation continues to be effective and proportionate. And we're not all taking our eyes off the ball and thinking about sort of 2 years down the line. That's absolutely not the case. We're completely committed to ensuring that regulation continues to be effective during the process of transition. So I just thought I'd underline that point. And on that note, I will stop taking up the Q&A time and be quiet. Thank you very much.
Thank you.